Trump's tariff turmoil continues to rattle markets and spur worries over the future of the U.S. economy. Goldman Sachs, for example, raising its forecast for the odds of a U.S. recession. That's the second one we've seen in a week. Here with more on all of this talk of recession, Stifel chief economist Lindsey Piegza. It's good to see you, Lindsey. I'm curious where you are on this question of whether the probability of a recession is rising, and if so, how likely is it, and what are you going to be watching?
Well, I think the probability of a recession is very real in the next year. We put it at about a 20% probability. So it's certainly not a zero probability, but that being said, it's not our base case either, as we continue to see relatively solid performance out of the U.S. economy. Now, the seemingly aggressive fiscal policy agenda coming down the pipeline does threaten growth, particularly in the first half of the year. But much of that is consumers and businesses responding in anticipation of a realized result from these policies. And we do expect perhaps the perception to be worse than the reality, allowing growth to move back into positive territory, more positive territory, meaning 1.5% to 2% in the back half of the year. Now, inflation is a different story. We do expect this sticky level of inflation to be exacerbated by tariffs and remain closer to 3% through the end of the year.
Lindsey, it's Kenny Polcari. How are you?
I'm good. How are you?
I'm good, thank you. Listen, you and I are very much in that same camp because I agree with everything you said. I think inflation is going to remain sticky. I don't think the Fed is going to be able to. I was in the camp that the Fed was not going to be able to cut rates this year, and I'm still kind of leaning in that camp because I think the inflation story is the one that's going to remain sticky. Now, I understand this whole tariff chaos that's happening and what it's doing and the perception it's creating, and I wonder if people are talking up this recession. It's almost like, if you say it enough times, it just happens, right? Which I certainly don't want to see happen. I don't think it's going to happen. But tell me your view on the Fed. Where do you think they are? Are they in a tough spot?
Well, I think the Fed right now is focusing more on the potential emerging weakness in the U.S. economy. As we've seen historically, the Fed is willing to tolerate above target inflation for some time. In fact, if we go back to the post-COVID environment, I believe the Fed stopped well short of a sufficiently restrictive level to get price pressures back under control. So there was much of this lingering inflationary turmoil that has nothing to do with tariffs that the Fed was still contending with. But even so, I think the Fed, looking at the level of policy right now, still in firm territory, would feel comfortable justifying maybe 1 to 2 additional rate cuts to get us back into neutral territory. The Fed isn't talking about providing undue support to an ailing economy, but they are trying to get policy back to a neutral level, which would give them justification for about a 50 basis point reduction. So some further relief, but certainly not in the camp of some of the more aggressive policy outlooks calling for 4 or 5 rate cuts in the remaining 9 months.
And Lindsey, I want to go back to something that Kenny just mentioned about sort of the idea that we can talk ourselves into a recession. I was struck by another headline today, this one from Larry Fink, of course, of BlackRock. He was speaking at the Economic Club of New York today. And one of the things he says is most CEOs, he says he talks to, say, we're already in a recession. As an economist, how do you think of that idea of sentiment driving us there? Is that how it works?
Well, the Fed talked about this, the disconnect that we're seeing between the survey data and the real data. Consumers' inflation expectations, for example, skyrocketing 170 basis points. Businesses reporting unprecedented levels of uncertainty. 90% of businesses say that now is not a good time to hire. Now is not a good time to expand their business. And so there is some of that that sentiment that translates into a self-fulfilling prophecy, right, which is likely causing the material downturn that we expect in the first quarter. Because remember, the impact of the tariffs is not going to be affecting the real data in the first quarter. But again, it's that sentiment, it's that uncertainty that's driving businesses and consumers to the sideline. But again, our base case is, yes, a dip in momentum, a dip in activity in the first half of the year, but retracing a lot of that lost activity by the back half of 25.
Something else I wanted to ask you about, another comment that I saw today, this one from Sean Fain of the United Auto Workers. He said in an interview he doesn't have much sympathy for people who hold stock, who are upset about the declines in the market right now. He says 60% of Americans have no retirement savings, which I think that number is a little higher than the actual number. But he says this is just Wall Street. It's people that are already rich. And most working class people are just trying to survive right now. But talk us through the relationship between the market and the economy. I know a lot of people say the market's not the economy. But when the market goes down by this much, it can become an economic problem, can it not?
Well, it certainly feeds into just what we were talking about, the sentiment of the economy. When the average American, whether or not they have a stake in the equity market, sees this negative reaction in the market, it can perpetuate concerns of a downturn, of a recession, of potential hardships coming down the pipeline. Yeah. So again, it can feed into that self-fulfilling prophecy, potentially exacerbating the realized downturn that would otherwise have been more muted if sentiment had been maintained in a more positive message.
Right. I think, Lindsey, I think the comments from Sean Fain are really short-sighted because all those union workers, their pension, where is it, just sitting in cash, or is it invested in the broad stock market for all those people? So for him to say, that 60% of the people don't care, he should turn around and talk to his own union members and see if they care what's happening to their pension and potentially their pension and 401ks, no?
Well, I think when we talk about these policies, it does come down to the timeline that we're assessing it through, the near term or the long term. Near term, there is likely to be some pain, be that in the equity market, be that in a downturn in the economy, higher prices. But the focus should be on the longer run reset of the global economy or the global international trade market as we talk about potentially revitalizing American manufacturing, creating longer term domestic jobs. But we can't bring factories back overnight. We can't expand production overnight. So again, a lot of the focus, a lot of the conversation needs to be divided clearly between the near term implications and the potential long-run results from these policies.
Well, and Lindsey, let's talk about the long-run results, and then we'll leave it there. Do you think that what's happening right now is an effective way to achieve that goal, that sort of revitalizing the middle class and lower middle class of the U.S. by trying to bring that manufacturing back? Is it going to be successful? Is this the way to do it? Is that even a worthy goal?
Well, it certainly remains to be seen whether or not this is a goal that can be achieved. But at the very least, I think I applaud the administration for trying to focus on a longer term goal to lift up many of the sectors of the U.S. economy that have been left behind, many of the individuals in the economy that have been left behind. But in the near term, there could be some sizable disruptions, particularly those for the middle or lower end of the income spectrum, if we do see this translate into a material loss of growth, into a material increase in additional prices, which are burdensome in and of themselves. But this is compounding on top of years of already massive price increases. When we look at housing, food, transportation, costs have risen nearly 30% over the last 5 years. So it really remains to be seen whether the average American is willing or able to stomach any additional cost increases, even in the near term, for the potential long-run benefits of these policies.
Right. Lindsey, thank you so much for joining us. Appreciate it.
Thank you.